Here we are at the end of 2022, and a lot of people are asking me questions like, what's going to happen in 2023? Is it going to bring us a recession? Are we going to get further decline in the real estate market? What's going to happen with our job losses? So a lot of things that I can share in this video, so let's go. Welcome back. My name is Yasin Nizami and I make these videos to educate my audience about the real estate market in Canada, particularly in the GTA, some macroeconomic factors, some geopolitical situations, some investing strategies. So if you are interested in any of these topics, consider subscribe, and let's get back to our topic of the day. So let's talk about the yield curve first. So yield curve is the key, I think one of the key indicators which can predict recession in the future. If you look at the 100 years of history, we can see that whenever we saw a inversion in the yield curve, it is followed by a recession 99% of the time. And if you look at the Canadian bond market right now, the spread between a 10-year treasury yield and a 2-year treasury yield is negative. So let me explain you. So the yield curve is basically a difference of yield between a longer term government bond and a shorter term government bond. So when we look at a 10-year Canadian Treasury bond that is currently yielding at around 3.29%, and the 2-year Treasury bond is yielding 4.05%. So it's basically an inversion of 80 bips between the 2 and the 10s. So that shows the economy is predicting a recession in the next 2 years. So let me explain. When you buy a longer term bond, for example, a 10-year treasury bond, you're supposed to getting higher return or higher interest because you're carrying a lot of risk, for the next 10 years, because a lot could happen in the 10 years. So in order to compensate that risk, you're supposed to getting a higher yield on those bonds, right? When you get less yield on a longer term bond compared to a 2-year bond, which is yielding 4.05%, that is telling us that the market is predicting a recession in the near future, could be between 18 to 24 months. That's what the market is telling us. And remember, market controls everything. No matter what central bankers can tell you, they cannot control the market. It's the opposite. Market controls them. Okay, so keep this in mind. So the economy is in poor shape. We can clearly see that it is expecting a recession in the next 12 to 24 months. And recession means basically job losses, less economic activity. When people lose their jobs, and by the way, our central banker has already said that he's trying to bring the unemployment number up. He's trying to see people losing jobs because that's what the aggregate demand being killed means. And that happens, then of course people will not have purchasing power to spend money in the economy, and that will impact the housing market as well. One of the key stats that I wanted to share with you is the historic sales volume. So what this graph is showing us that in December 2022, our number of sales in the TREP data has gone below the lowest in the last 2 years. So the lowest we saw was in April 2020, right at the peak of the pandemic, when everything was being canceled, everything was being closed down. We saw the lowest level of historic sales volume in that month, and in this December we have broken that record. So that's how the slow the market is. And the reason is because there is not enough inventory, there is not enough buyers ready to spend money. A lot of buyers that I'm talking to, they have this perceived idea in their mind that the prices will go further down and they will try another round in the time of April and May timeframe, when the spring market will come back on. And a lot of sellers are basically digging their heels and they're not willing to reduce their price because they don't have to. Right now the sellers are the only ones who are selling for maybe upgrading or downgrading, or they have to sell. But if you are a seller who does not have a desire to sell, you're not willing to move the price, right? So the people who have taken mortgages in the time of 2018 and 19, their mortgage term is coming up for renewal sometime around right now, right? So most of those people have taken fixed rate mortgage rate around 2 or 2.4%, right? And when they're going to renew, they're going to get a rate in the north of 6%. So a lot of people will get a sticker shock when they renew their mortgages from 2% to 6%. That is going to increase their monthly payment significantly, and it is going to reduce their overall purchasing power in the economy. So when you see people's mortgages are going up, it's going to directly have a negative impact in the purchasing power in the economy. So this will front run the slowdown in the economy for central bank. So when people will not have enough purchasing power to spend money and buy food and go for dinner or go for vacation, then ultimately this will slow down the inflation in the consumer economy. So that's what we are seeing right now, and the rates are already too high with regards to the debt level that we have in the household level. So a lot of people are asking question, okay, is Bank of Canada going to raise another rate by 50 basis point or 25 basis point? My answer to them is it's irrelevant, how much rate hike they're going to do. The key question is how long these rates are going to stay. The longer these rates are going to stay, the harder it is for people to carry on their mortgages and continue paying those monthly higher payments going forwards. So that will put a lot of downward pressure on the consumer market from a purchasing power perspective, which will result into the qualification of the mortgage for buying a residential real estate in Canada or in GTA market. So nothing is bullish right now with regards to real estate market because the rates are already too high compared to the debt level. I know that people will say, oh, in 80s we had 17% rate. Yes, but the debt level was much lower than what we have today in the consumer household. So that is going to give a lot of pain in the economy. And I don't know whether rates will come down next year. My reading so far is the rates are going to stay at current level for the entire 2023, and maybe 2024 they will start cutting rates down, and it's all depends upon the inflation rate. If the inflation is going to come down, maybe yes, they will bring the rates down again, but the inflation stays sticky, stays at the higher level, then I don't see why Bank of Canada will cut down rates early than 2024. So this is just my thesis. I could be wrong. Let me know what you think, and I'll see you in my next week video. Take care.